Imagine it's a Thursday night in 2026, and you're standing in the kitchen after dinner. The plates are still on the table. A homework worksheet is spread across the counter. Your phone is open to your banking app, not because anything catastrophic happened, but because you just feel the need to check. You and your partner both work. You earn more than your parents did at your age, at least nominally. You live in a decent neighborhood. The fridge is full. The kids are healthy. By every visible metric, you are doing fine. And yet there's this quiet, persistent thought that slips in at the edges. Why does it feel tighter than it should? Why does stability feel so expensive? That question is sitting in kitchens all across America. Families aren't collapsing en masse, they're functioning. But many feel poorer in 2026, even when incomes are higher than ever before. The feeling isn't dramatic, it's subtle. It's the sense that there's no slack in the system, that one unexpected expense could rearrange the entire month, that saving for the future feels like stealing from the present. To understand this, you have to zoom out beyond a single grocery bill or mortgage payment. Start small. Think about housing. In many areas, the cost of buying a home has moved far beyond what a single income can reasonably support. Even dual-income households stretch to qualify. Property taxes rise with home values, insurance premiums adjust to new risks, maintenance never disappears. The house that once symbolized arrival now behaves like a long-term financial anchor. It's not just a place to live, it's a commitment that requires constant feeding. Then there's childcare. For families with young children, childcare can rival or exceed a mortgage payment. It's not optional, it's the price of participating in the workforce. If both parents work, they pay for care. If one steps back, they sacrifice income and career progression. Either way, there's a trade-off. In previous generations, extended family often lived nearby. Costs were shared implicitly. In 2026, mobility has separated families geographically. Independence is higher. So are expenses. Education adds another layer. College savings feel mandatory, not aspirational. Parents who struggled with student loans themselves feel a moral pressure to shield their children from the same burden. So they contribute monthly to 529 plans while simultaneously paying off their own debts. It's a financial overlap that didn't exist in quite the same way before. They are funding two futures at once, their children's and their own retirement. Healthcare, too, behaves differently than it once did. Even insured families face high deductibles and unpredictable out-of-pocket costs. One emergency room visit can undo months of careful budgeting. The anxiety isn't constant, but it's ambient. It lives in the background. Add groceries, utilities, transportation, insurance, extracurricular activities, birthday parties, sports fees, summer camps. None of these are extravagant. They are the texture of normal childhood. But normal childhood has become layered with costs. The modern family experience is curated, structured, optimized, and optimization isn't cheap. Psychologically, comparison intensifies the pressure. Social media doesn't just display luxury lifestyles, it displays curated normalcy. After-school programs, renovated kitchens, annual vacations, organic meals, tutoring, travel sports leagues. The baseline of what responsible parenting looks like has shifted upward. You don't consciously compete, you absorb standards. And when your income rises, those standards expand to match it. That's where the emotional contradiction emerges. Families earn more than previous generations in raw numbers, but asset prices have risen faster than wages. Housing appreciates, education inflates, healthcare climbs. Families dependent solely on income feel like they're chasing a moving target. If they don't own appreciating assets, their financial progress feels incremental rather than exponential. The old expectation was that time alone would make things easier. Work hard, earn more, life stabilizes. In 2026, many families work harder and earn more, but the stabilization feels fragile. The margin between earnings and obligations is thin, and margin is what creates the feeling of wealth. Without margin, even a high income feels tight. There's also a structural shift in how risk is distributed. In earlier decades, pensions were common, employer loyalty was higher, housing costs were lower relative to income. Today, retirement responsibility rests heavily on individuals. Investments must be managed, healthcare must be navigated, job stability feels less guaranteed. The safety nets that once buffered families have thinned, even as opportunities have expanded. So families carry more personal responsibility for long-term security. That responsibility weighs on everyday decisions. Should we upgrade the car? Should we move to a better school district? Should we take the vacation? Each decision is filtered through long-term financial implications. The cognitive load increases. Feeling poorer in 2026 often isn't about actual deprivation. It's about financial tension. It's about the absence of breathing room. It's about looking at a decent salary and realizing most of it is already assigned. When income is fully allocated before it arrives, abundance feels theoretical. The deeper realization is this: wealth has shifted from income to structure. A family earning $120,000 with low fixed costs, modest housing, and growing investments may feel calmer than a family earning $200,000 with maximal commitments. The difference isn't just salary, it's leverage and flexibility. Families feel poorer because modern life is engineered at full capacity. Two incomes often replace what one income once covered. Childcare replaces extended family support, subscriptions replace ownership, upgrades replace repairs. Each improvement enhances convenience and comfort, but also adds permanence. Permanence reduces optionality. Optionality is what makes people feel secure. The powerful shift in perspective is recognizing that the feeling of poverty isn't always about lacking money, it's about lacking space. When every dollar has a destination, the system feels tight. When incomes scale automatically with expenses, progress feels invisible. But when families intentionally build margin, keeping fixed costs lower than their earning power, prioritizing ownership over optics, letting income grow faster than lifestyle, they restore something deeper than savings. They restore calm. In 2026, many families don't feel poor because they are failing. They feel poorer because the cost of modern stability has risen quietly and steadily. The solution isn't simply to chase higher income indefinitely, it's to redesign what stability requires. Because true wealth for a family isn't measured by square footage or school rankings, it's measured by how resilient they feel when life moves unexpectedly. And the less fragile your structure becomes, the richer you actually are, no matter what the headline numbers say.